Okay, well, time for the money show then. And like I said, today we'll be talking about all the steps you need to take, the assets that you need to continue with, or the assets that perhaps you're better off without in these times of uncertainty. And I guess this session of the show is going to be especially useful for those individuals whose goals are fast approaching. It can be all the more very perplexing to understand what to do because you may need, the purpose for which you had invested your money may be fast approaching, but now you're seeing all this volatility in the markets. So let's introduce now on the show Shweta Jain of Investography to understand how you can vaccinate your portfolio from all the vagaries that the market does subject your portfolio to. Shweta, thank you so much for joining us today on the Money Show, and I hope you are doing well, keeping safe. So Shweta, to start with, could you tell us about all the steps that an investor needs to take, a retail investor needs to take if he or she wants to deal with this volatility, or in fact, for that matter, is it necessary for long-term retail investors to always have some sort of a reaction, some sort of steps to take when there's this whole conundrum going on?
Hi, Mubina. Thanks for having me on the show. And yes, I'm doing well, thankfully. I hope you are doing well too. And I hope our viewers are doing well and staying at home and staying safe. Vaccinating the portfolio is interesting because vaccination doesn't mean that nothing will happen. It just means that whatever happens will not impact you as badly as it could have without vaccination, right? So the impact is much lesser. So some of the things that our viewers can do is one, definitely keep a cash position. When I say cash position, I don't mean take a call on whether the market will be up or down tomorrow. I mean, have your liquid fund ready, which is the next 6 months expenses. And this is irrespective of, any pandemic around. We've usually said this is sound financial advice, but now even more so in these times, have at least 6 months of expenses stashed away that you can access easily at a moment's notice without any market fluctuation or impact. Add to this, any short-term goals that you have in the next 1 year, keep that money liquid. It's a good time to liquidate that money for the next 1 year if you have any goals. I don't mean the travel goals. I mean any other goals that you have, because travel may still be a distant dream for a lot of us. What I would also say is don't see day-to-day noise, which you will see, all around you. If you're a long-term investor, make sure that you are sticking to your goals. Instead of looking at the markets daily, look at your goals daily. Look at your, whether it's your child's education goal, whether it's the marriage goal or your retirement goal, whatever goal it is, look at your goals and keep investing. When there is falls in the market, when there's uncertainty in the market, keep investing so that, you're ignoring that noise and you're keeping your eye on the goal and you're staying invested. And don't get emotional about your portfolio. Be emotional about the goal, not the portfolio. Booking profits at this time is not a bad idea, according to me, especially if your goal is in the next 1.5, 2 years, because I don't like trying to time the market, So make sure that you are building that liquidity immediately. Make sure you have your health and life insurances. These are sometimes things that take a back seat for us. Don't ignore it. Now we cannot afford to ignore it now more than ever.
Shweta, something else that we noticed, like, for example, during the last wave, the markets, of course, dipped quite significantly, and then there was this major rally. Many investors started, mutual fund investors started redeeming. Is that really the right approach? That, okay, when the market rallies, you start redeeming your mutual funds?
So yes, we did see this last time, Mubina, so true. But I don't think that's the right approach, because in equity, even equity mutual funds, you don't see linear returns, right? You see, you'll see 1 year with negative returns, you'll see 3 years with no returns. And that 1 year where you're staying invested will make up for maybe, 5, 7, 10 years of returns that you will see, right? So equity is volatile, which is why you have to stay invested and you have to give it time and not time it. We usually want to sort of show ourselves more than anybody else that, we've got this call, right? I've booked 10% profit. But what is 10% when it could become 10 times? That's what I mean. So in equity, the idea is to multiply your wealth. So the only way you can multiply your wealth is by staying invested, not by booking profits at 10 and 15%.
Okay, absolutely. So, Shweta, tell us what are, if I could call it, the assets that one must have in their portfolio to sort of at least put some sort of a moat between your portfolio and, all the volatility that markets do tend to put your portfolio through.
So the first thing would be cash, because if there are falls in the market and you don't have cash, it's no point of any correction. You'll just keep looking at the market and say, I wish I had money to invest in. Cash, definitely. Second is, I would say gold, especially in times like this. Gold is a good exposure to have. So I don't mean, put 50% of your assets in gold, but a 10%, maybe even 15% exposure to gold is a good idea. You could have a very diversified portfolio. So that way, even if something is happening in India, not necessarily all your money is impacted because you have some money, say, invested in the US market, something in China. So diversified portfolio across assets and across countries is a good idea. Some bit of exposure to defensive sectors, maybe like an FMCG or healthcare, is again something that we can do to have to minimize that volatility. And definitely cash again, because you do need to run your household, to run your businesses, so to meet your short-term goals, because school fees will not wait, right? You will still have to pay some of these expenses. So cash definitely again.
So, last year we saw a massive rally in gold prices because of, what we saw. Gold prices went to 56 and 57,000 rupees. Does that always happen? Because many a times investors will think that, okay, once again, equity markets are going all over the place, so gold will again rally. Is there a thumb rule of sorts on that front?
So more than anything, I think gold last year went up because people just didn't know what to do with money and say, did not know if keeping it anywhere else was going to be safer, whether it's debt options, whether it's equity. So gold becomes like a last resort option, which is also easily carried from one place to another, easily liquidated. So that's one of the main reasons why gold rallied like the way it did. Having said that, not that gold isn't volatile. Regular exposure, regular investing in gold is something that we would recommend. Even in our culture, we invest in gold at least twice a year in the Hindu tradition, whether it's Akshaya Tritiya and Dhanteras. So that way, at least you're buying gold 2 times a year and making sure there's some bit of exposure. I would still say continue to invest in gold as a sort of hedge against inflation, against for want of better liquidity, right? So I would say definitely keep some bit invested in gold, but not more than 15%.
Okay, you answered my next question as well, and that was how much of the portfolio should be in gold. So not more than 15%. In fact, that's a standard rule you should understand. Like 10 to 15% is a good amount to keep in gold. Now, you mentioned cash as well as a good, component of your portfolio during uncertain times. So, Shweta, from what I understand, are you saying that one should cull down their equity holding and hold that cash? Or are you saying that if possible, I should try and have more surplus cash that I am ready to invest it during uncertain times?
Okay, so this is going to make me unpopular on both the fronts now, because one is definitely book some profits at times like these for the next 1.5 years, whatever goals you have, book your profit now so that, you're not necessarily to book a profit. You're doing this to protect your goal. Understand that the requirement is more important. So to protect that, we need to make sure that we have liquid money, because markets are markets. You could see 15-20% correction in the next couple of weeks, couple of months. So you cannot say what will happen when you really need the money. So when markets are doing well, book that profit, withdraw your investment so that this is available to you when you need it. So that's liquidity is most important. Second, yes, you have to cut down on your expenses at times like these, and make sure that your emergency fund is not coming from, say, liquidating equity, but coming from cutting down on your spending. You shouldn't compromise on your long-term assets for your short-term goals. I strongly believe in that. So cut down your expenses, cut down your spending, and make sure that your emergency fund is built for that as well.
So, okay, so basically, just to reiterate for the benefit of our viewers, if someone's goal is nearing, and now, of course, they are faced with volatility. Let's say if someone was ready to retire this year or maybe next year, and now, of course, they're seeing that the equity markets are all over the place. How do you recommend they slowly start, ensuring that their portfolio is ready for such times?
So retirement is a little tricky because even in retirement, you're not going to need everything at one time, right? You're going to need the next few months' expenses. So for people who are looking at retirement, I would say keep 2 years of expenses in, say, debt and short-term debt funds and liquid options. More than that, maybe 2 to 5 years, keep in some sort of long-term debt. But beyond that, you can still stay in equity. So retirement doesn't mean that you need to stash all your money under your mattress. Make sure that your overall portfolio is still beating inflation, because retirement itself, that whole period is at least 15, 20, 30 years time. And you need to make sure that you're beating inflation throughout that. Otherwise, your lifestyle will need to continuously deteriorate, right? Because money's purchasing power will keep coming down. So for 2 years, keep your expenses in short term. For 2 to 5 years, long-term debt. Beyond 5 years, you can still stay invested in equities.
What if the goal is then education, if you're paying for education?
So if the goal is education, then definitely keep it liquid, because you would need to pay these school fees. You cannot keep postponing that. If the child is at X age and he will need to get into a particular grade, he will need to pay that fee. So definitely liquidate that money now rather than later.
Okay, I think, Shweta, we've largely covered everything. Let's say do you think that, when we see such a downtake if an individual has a good amount of investable surplus, should they go all in during, when the market is down, or what is the strategy you would recommend such investors who are blessed to have this investable cash with them?
So even when we have investable cash and markets are down, it's not easy to invest at one shot. And I would think it's not a good idea as well. So imagine somebody had money last March. Now, even I keep cribbing that I didn't have the money, and if I had the money, I would invest. But imagine we did have, say, 1 crore at that time. Would we be investing the entire money at that time? Imagine somebody's PF money had just come out and he'd received that. He was looking at retirement. March, markets were very, very attractive, and, sentiment was negative everywhere. It's not easy to invest that 1 crore in equity, even if you had to have that kind of exposure. So what one could do is stagger their investments. So say you had 100 rupees to invest today, and you're looking at today, right? So markets are at highs and quite volatile. If you're looking at investing today, I would say start investing. Don't delay investing. So start investing 10 rupees of your 100 rupees today and invest it over the next, say, 10 months, so that in between, if you do see huge dips, you still have that liquidity and you have that option of moving into equity. Because if for somebody who's never invested in equity or even has limited equity experience, it's not easy to see your money move from 100 to 90 or to 80. It's very, very painful to even see your money move from 100 to 99 because it's a hard-earned money. So I would say staggered investment so that you're not going to be scared of investing in equity, because it's very easy to get scarred in equity and never to come back. I want investors to continue to come back to equity and stay in equity.
Well, I think with that, we'll take on board some questions and queries from our viewers then. If you'd like to connect with us, you can write in on themoneyshow@etnow.tv. Our first question is from Geeta Pillai. She says, I'm 58. I've taken a VRS last year. Both my sons are as well employed. We have sufficient liquidity by way of senior citizens deposits, bank deposits, all mutual funds. She has 2 flats, ancestral property, plus monthly pension from bank service. Now I have 8 lakhs more to invest. Where do I invest for high return? Okay, what do you recommend she starts off with then, Shweta?
Okay, that's an enviable position to be in. Congratulations. I would say, because you've said mutual funds, I would assume there's some bit of equity mutual funds as well. But even if you don't have equity mutual funds, you could start building on equity mutual funds to build your wealth. And because you said you're looking at high return here, I would say start off with 2 funds, one index fund and one a mid cap, small cap kind of a fund. So I would say then invest in like an ICICI Nifty Next 50 fund and a Kotak Emerging Equity Fund, because there's one which is sort of passive and one which is a little more aggressive and active. And because you can take risk, continue to stay invested. Don't get hassled by the volatility in the markets. One will definitely be more volatile. So you'll be tempted to say move to one of the funds which is giving you decent returns, but not as volatile as the other, because definitely the nature of the funds is different. And the reason I'm suggesting 2 funds is because they're sort of complementary and not similar in nature. So make sure that you're investing 4 lakhs in each of these and stay invested. You can start off with, say, 1 lakh now and continue to invest in the next 8 to 10 months. And if you see bigger corrections, you can invest more than a lakh and a half as well.
Okay, I think we have time for one more question. It's from Krishnan CP, a very interesting one. He says, how does one go about selecting a mid-cap fund that can deliver good CAGR in the future? Okay, a tricky one at that. There are so many mid-cap funds out there. Some of them have done very well. In fact, this category in the last 1 year has finally outperformed large caps. So yeah, Shweta, how do you go around selecting a fund? You know, we have almost 30 to 40 mutual fund houses, right? So how do you select which one is good for you?
Okay, so quite a tricky one. I would say first look at the fund house and the fund manager, look at a good track record, because this does give you some bit of confidence in that. Don't just look at the last 1 year returns, look at 3-5 year returns and see what has the volatility been, what's the Sharpe ratio. Also look at what are expense ratios, what's the portfolio turnover, so that you know how much of the portfolio is being churned. You see how actively they've been buying and selling. Also look at the portfolio and do your own digging into some of the companies there. There are fund houses that do talk about the holdings that they have, do share more details about the businesses. Remember, these are not just tickers on the market, but these are real companies, real businesses. So look into these parameters that the fund houses itself choose to build these companies. There could be, zero debt companies. There could be companies there which are into growth, which are value based. So look at your parameters, see what is suiting you, read the documents more carefully, read the fact sheets, look at them for a period of time, not just say one time and you've done your investment. Listen to the fund manager and track the fund for a few months before you start investing. And one of the other things that you can definitely do once you've selected the fund is invest systematically rather than go lump sum into that. What I would also say is, if you're looking at different mid-cap strategies, choose 2 mid-cap strategies instead of just one, because there will be different kind of companies that will be there in your portfolio. Then, even though these are mid-cap companies, the portfolio could be very different. So I would say then, if you're looking at mid-cap, look at different parameters, look at the fund mandate, look at how well the fund manager is following that mandate as well. Listen to fund manager calls if you can. You can see their interviews. So then that gives you much better idea of whether you're aligned to their strategy or no, or if the portfolio is aligned to your goal strategy or no.
With that, we'll wrap it up. So thank you so much for joining us today on the show and, guiding our viewers through these tricky times. I hope you stay safe and well. To all health insurance companies with regards to the health insurance claims that people like you and me put forward. Remember that there have been reports about a lot of hospitals denying cashless facilities to COVID-19 patients. Now, the regulator says that if the policy is eligible for cashless claims, then the insurer has to ensure settlement. We'll take forward this topic on The Money Show in the days to come. But for now, we're going to wrap it up. Thanks for watching.